Welcome back to the Daily Crypto Deep Dive. Today we're going to take a deep look at one of the most important XRP developments of the entire month. The $100 million whale dump that hit the market just before what looked like a clean breakout window. This is one of those stories that most traders saw flash across their feed without fully understanding what it meant. But when you step back and really analyze what happened, who sold, why they sold, how much they sold, and what it did to XRP's structure, you start to see that this wasn't just a big red candle or a temporary setback. It was a moment that revealed the tension between long-term holders, speculative buyers, retail enthusiasm, regulatory uncertainty, and the broader sentiment in the crypto ecosystem. And in this deep dive, we'll walk through everything that matters about the whale dump, what it tells us about price direction, and why analysts are divided on whether XRP is being suppressed, reaccumulated, or simply behaving the way an asset behaves under heavy distribution pressure. So let's start from the very beginning. Over the past week, wallets holding between 100 million and 1 billion XRP began unloading significant amounts of tokens. And by significant, we're not talking about $2 or $3 million. We're talking about hundreds of millions of dollars in value leaving whale addresses and moving onto exchanges or directly into liquidity pools. According to Sentiment's data, nearly $600 million worth of XRP has been offloaded by these large players since December 5th. But the moment that really caught everyone's attention was the $100 million sale that happened just before what looked like the ideal breakout window. XRP had strong volume, strong sentiment on trading platforms, and was approaching that $2.20 resistance level that analysts had highlighted for over a month. A breakout above that mark would have opened the door to $3, which is psychologically huge because it marks the beginning of the long-awaited reclaim of the pre-2021 structure. But instead of breaking out, the market took a punch. Not because retail sentiment changed, and not because technical indicators failed, but because a massive amount of supply entered the market at once. And supply at that scale cannot be ignored. It changes everything. You can have the best structure in the world, the strongest candles, the cleanest support, and the perfect confluence of indicators. But when a whale dumps that kind of volume, the market absorbs it whether it wants to or not. And in XRP's case, that absorption didn't trigger a collapse, but it was enough to stall momentum. It was enough to flatten out an otherwise healthy trend. And in many ways, that's the part of the story that matters most. Because the whale dump didn't break XRP. It slowed it. Let's talk about why that's so important. When a whale sells, one of two things can happen. Option 1. The selling overwhelms demand and causes a sharp drop in price, often resulting in cascading liquidations and panic. Option 2. The selling is absorbed by patient buyers, retail enthusiasm, and institutional positioning, which prevents a crash but still limits short-term upside. What we saw with XRP was the second scenario. The market didn't implode. Instead, it absorbed the supply. And that tells us something crucial. There is still strong underlying demand for XRP at these levels. Even with $100 million worth of tokens hitting the books, the asset didn't collapse below $2. It wobbled, it hesitated, but it didn't break down. And that kind of resilience is usually a sign of accumulation, not distribution happening beneath the surface. But that raises a new question. If the market is strong enough to absorb such heavy selling, why did the breakout fail to materialize? And this is where analysts start to split into different camps. The first camp argues that whale distribution is a natural part of long-term market cycles. These addresses are early adopters, sometimes corporate balances, sometimes treasury management wallets, and they often sell into strength. For them, the reasoning is simple. When XRP moves toward a resistance level that has historically acted as a ceiling, whales take profit. They reduce risk. They sell into retail enthusiasm, because that's when liquidity is easiest. According to this view, the whale dump isn't malicious, orchestrated, or manipulative. It's just normal market behavior from players managing massive exposure. But the second camp sees something different. They argue that the timing of the sale, landing exactly as XRP approached a breakout level, is too precise to be coincidence. From their perspective, this looks like coordinated suppression. Large holders keeping the price under control until certain events, such as regulatory clarity or settlement decisions, take shape. This theory isn't new in the XRP community. For years, traders have debated whether whales and leveraged players intentionally cap price action to prevent parabolic moves. The argument goes like this: if XRP breaks out too soon, before regulatory clarity or institutional pipelines are established, the market becomes unstable. By keeping price subdued, large players buy time to reposition, accumulate, or wait for litigation cycles to resolve. And while there's no way to verify this theory, the timing of the dump absolutely fuels speculation. But let's look at the data rather than the emotion. Whale sales are visible on chain. They're measured. And in this case, the sales came from wallets that historically distribute when price approaches resistance zones. In other words, the dump aligns with past behavior. And while it's easy to construct narratives about suppression, the more grounded explanation is that whales simply saw an opportunity to offload at strong prices during a moment of high liquidity. Whether that's seen as strategic or manipulative depends on the perspective of the individual trader. Another key point here is volume. In the last 24 hours, XRP's trading volume rose nearly 60%, hitting close to $4 billion. $4 billion in volume on an asset trading at $2 means that around 3% of its entire circulating supply changed hands in just one day. That's a huge turnover. And high turnover during whale distribution is a sign that the asset isn't weak. It's liquid. Liquidity is what allows the market to handle a $100 million sale without collapsing. Illiquid markets break under that kind of pressure. XRP didn't break. It held the $2 range. And that's why analysts consider the structure shaky but not destroyed. The whale sale didn't unravel the trend. It just delayed it. Now let's talk about psychology, because psychology is often the most powerful force in crypto. Retail traders saw the volume spike, they saw the whale dump, and many assumed the breakout attempt had failed completely. Some took profit, some hesitated to enter, and some simply froze, uncertain of whether the dump signaled the beginning of a new downward cycle. But whale selling doesn't always spell bearish reversal. In fact, in many bull cycles across multiple assets, whale distribution actually precedes the strongest continuation phases. Why? Because whales distribute early, long before the peak. Their strategy spreads risk, reduces exposure gradually, and ensures liquidity for exits. Meanwhile, retail buyers and institutional players step into the vacuum they create. This dynamic fuels long-term growth. So what does this mean for XRP? If whales are distributing but price isn't breaking down, that usually means buyers are willing to take those tokens at these levels. And that's exactly what we're seeing. The range between $1.90 and $2.10 has shown remarkable resilience. Analysts who study order books have noted that bids continue to replenish after each dump. This suggests a market that is not only absorbing supply, but quietly accumulating at the same time. Accumulation under resistance is one of the clearest signals of preparation for a future breakout, even if the timing is delayed. But of course, no analysis is complete without considering the opposite scenario. What if the dump is a warning sign? If whale selling continues at this magnitude and buyers eventually weaken, the market could lose momentum and fall back into a deeper correction. This is why the next few days are critical. If XRP holds above $1.85 to $1.95, it keeps the structure intact. If it breaks below that range with strong volume, the whale dump may have triggered a broader shift. But so far, the market has not shown signs of collapse. Buyers are defending key levels. Now let's look at the breakout question. Can XRP still move toward $3 after this whale dump? The short answer is yes, but with conditions. The dump hasn't invalidated the breakout structure, but it has delayed it. For XRP to push through $2.20 and head toward $3, it needs three things: stronger retail participation, clearer momentum indicators, and reduced whale distribution. Retail participation is rising, as seen in the volume numbers. Momentum indicators are mixed but not bearish, and whale distribution may ease naturally after large players finish repositioning. Analysts from several trading desks have noted that the pattern forming on the chart resembles a compression wedge. Compression followed by high-volume accumulation often leads to explosive moves once resistance breaks. And because XRP has historically moved in sharp, sudden bursts rather than slow climbs, the delay caused by the whale dump might actually set the stage for a stronger breakout later. We should also talk about the role of narrative. XRP's biggest catalyst is still regulatory clarity. The SEC ruling, institutional adoption, cross-border settlements, these themes are all active drivers. When a whale dumps ahead of a major narrative shift, sometimes it's not suppression, it's anticipation. Large holders might be repositioning ahead of a major move, whether bullish or bearish. And ironically, the dump could mean confidence. If whales believed XRP was about to crash or lose relevance, they would have dumped much earlier. Selling near resistance suggests they expect buyers to be present. And buyers are present. And that is the full picture. The psychology, the liquidity, the structure, the sentiment, and the implications behind one of the largest whale dumps of the year. As always, the market will decide the next chapter. But what we've seen this week is not the end of the story. It's a setup for whatever comes next. Thank you for listening, and as always, we will see you at the top.